Yeah, so we're going to try this a little bit differently, where we're going to speak to one guest for a little bit. So if it looks like we're just speaking to one person and not everyone else, it's actually, we're doing that deliberately just to give that person a little bit more time and context. And we're not ignoring everyone else. And then we're going to open it up to broader questions, and then that's when everyone can interact and engage. So Archana, do you want to start with it? But first we'll do the opening question, which is the introduction question.
Yes, so you know, the way we lay it out is, of course, we, just like I told Sean, that we cannot introduce you better than you can yourself. Why? So if you can introduce yourself, how you are here, and then what is it that you do in your roles. And I think that would be a great starting point for us to have follow-up conversations and a deeper dive into, one, your role, and secondly, your organization and how you're innovating the healthcare space. So Steve, since you have the wine glass.
It is on the floor.
So they're too far away for you?
Get me done and I can get back to it.
Okay.
By the way, that picture is at least 5 years old.
Really?
So I'm Steve Wigginton. I'm the CEO of a joint venture between Sutter Health, which is a $14 billion health system here in Northern California with about 55,000 employees, including my dear wife, Nancy, who's a practicing OB/GYN. So I get the pillow talk view of healthcare and insurance. Pillow talk. And I would say, and then Aetna, many of you may know, it's about a 45, well, it's about, all told, about a $68 billion company. It's been consumed now, or acquired, I guess would be the more appropriate phrasing, by CVS Health. 300,000 employees, 10,000 pharmacy locations across the United States. So two very traditional, I think the enemy of most of our entrepreneurs in some ways. I spent most of my career competing against these entities, and now I'm trying to bring the two of them together. The way I described my role when I first started was, and I still do, I guess, it's like I'm trying to conduct a marriage between two families of radically different faiths and traditions. Excuse me. The culture in a provider organization is insurance is bad. They tell us what to do. They don't pay us for the great work we do. And the insurance company is saying, hey, HP is telling me drive my costs down, give me better rates. Not just HP,
full
obviously,
disclosure,
but
no.
full disclosure, no. But again, full disclosure. But the point being, it is an interesting intersection between two people who are talking past one another. Mm-hmm. I took the role because it's actually a chance to acquire many of the entrepreneurial capabilities that have been described here. We are deploying for next year a virtual primary care practice that was started in Seattle called 98.6. We're providing it for free to all of our members. We have launched a partnership with a company called Heal, which provides either home or office visits for $179, and we are underwriting one of those per year. So we're trying to lower the barriers for the front door of healthcare. At the same time, we've negotiated favorable rates with Sutter and all of their great facilities, as well as Stanford, just up the road. Up the road? Have I got that right?
Sideways, yeah.
Sideways. Yeah. I'm not a peninsula person, so help me here. But and so we have the best of, like, if you get really sick, the wellness programs and the other things go out the window, and now you're sort of wanting the best care possible with the best specialists and the tightest coordination possible. But for the vast majority of the commercially insured population, that's not actually what they need. They need more basic sets of services with more cost visibility and transparency. So we're trying to bring that to a 186-year-old insurance company and a 105-year-old provider organization.
Oh. That's excellent.
Just go down the list.
Yes, go down.
So
are we going ping pong?
No.
No, okay.
Doesn't matter.
All right, so Jenna.
My name is Jonna Kuritz, and I'm an associate at Anthem. I am housed within the National Account Organization. In fact, I'm on the National Account Leadership Team. My primary responsibility for the past 5 to 7 years has been to work on innovations within the national account organization and the company, which tend to then be more readily adopted throughout our organization. In the past 7 or so years, our focus has been on really 3 pillars. One is provider optimization. It has to do kind of with contracting. It has to do with the kinds of things, creative things that Sutter and Aetna did in creating a narrower network specifically for one customer, but can be then launched more broadly. Focusing on the consumer experience, so expanding the digital capabilities and the web-based capabilities so that we can better have members engage, in their health and do the things that we want them to be doing to be smarter consumers. And then the last thing is on health activation. Very, very important. It used to be that we were relying on clinicians within a health plan to reach out to individuals. We now are ever more reliant on the primary care physician infrastructure to take on some of that, care management on behalf of our members, because clearly members are going to listen to their providers before they're going to listen to an insurance company, and then leverage those inbound calls that are coming to us, but also starting to anticipate those individuals that are going to be calling us in the future and proactively reach out to them. And then also really leverage the digital channel by making it very, very robust to serve as a benefits hub. So it's a destination for individuals to go to so that they can take more action in their health.
Thank you. So,
yeah, hi. I'm Abir Sen. I'm co-founder and CEO of Gravy. So I'll give you a 30-second description of what Gravy does. I'm happy to go on deeper later. But we allow employers to move to a defined contribution approach in healthcare. So what does that mean? Well, we think that it's crazy that your benefit manager has more say about which doctor you go to than you do. So in our model, the employer says, look, this $10,000 or so I'm spending on healthcare and health benefits, health insurance. I'm going to give that to my employees through the Gravy platform. And then think of us as a marketplace of benefits where we take everybody's needs into account and then essentially create a customized portfolio of goods and services, insurance, other products, that is really meets the need of your family versus the one-size-fit-all approach that used to be the case in the legacy model. So at the end of the day, the employer, much like they've done with pensions, move to 401ks, they make one decision, which is how much money am I going to spend on healthcare? They give the money to the employee, and then it's between us and the employee from then on.
I'm Michael Yang. I'm with Omer's Ventures. We're a venture capital firm, and I've been investing in healthcare technology, healthcare services that are tech-enabled, and digital health for a bunch of years now. Some of the investments that I've made along the way include Accolade, which is in the employee-employer navigation and advocacy space, in Brightside, which does something similar in the financial health and financial benefit space, and then also Purewell, which is a San Francisco-based company that's in the musculoskeletal condition management space.
excellent.
Sean, do you want to reintroduce yourself?
Yeah.
Do I really
That's
need
fine.
to?
Okay. Okay, then we'll
So,
start.
Sean is
and-
from Bind.
Yeah.
Sure.
Yes.
So we can start, and we will start with Steve. Now, this is a time we'll just take a little bit of a deeper dive with each person. So with Steve, we'll start with you because, well, you're representative of, one of the oldest firms here.
Thanks for that.
And there's a lot happening with some of these incumbent firms in the industry. There's lots of consolidation we're seeing with lots of provider consolidation, lots of partnerships with Aetna. Clearly, there's a huge CVS Aetna partnership now, which is interesting. CVS Health is before the name Aetna. Sutter Health is before the name Aetna. It almost seems like Aetna sort of wants to brand itself somehow with a different, sort of a different face to make, to build this trust that we're all talking about. But the question is, why are we seeing this broadly in a macro sense? Why are we seeing some of this consolidation in the industry? And are some of those reasons also driving, where they drove Aetna and Sutter Health to partner?
Well, we wouldn't be sitting here if the health insurance industry and the providers of care had figured out how to eliminate administrative waste and be tightly coordinated. So next week I'm giving a talk in a different environment, and some of my slides have the Hatfields and the McCoys. Some of you who didn't maybe grow up in this country or younger than me don't know the Hatfields and McCoys, but they were neighbors in Kentucky and they've never gotten along, even though they live in the same little county. And so that tug of war between you're not paying me enough for the care I'm providing and you're charging too much, and the variations in care and what is the appropriate care, that tug of war creates a lot of inefficiency. So the rationale behind doing a joint venture is we just put 50% of our stake, the payer and the provider, in the middle, and we say, what if we have aligned interests, truly aligned economic interests? Could we eliminate a lot of this crap, which is a technical term for administrative waste? My wife, as I mentioned, is an OBGYN in the Sutter system, and she is a 2-time Patient Choice Award winner. And this is a pretty rare award, and I think they've been doing it for about 5 years. I think they do maybe 3 or 4 specialists a year, so some of you are better at math than me. She's maybe like 1 out of 5. She's very close to not wanting to practice because of that friction and that back and forth. And my business is not going to fix that, unfortunately, not quickly enough. But that's the intent. The employers who pay for the majority of healthcare. How many of you are aware of the cost shift dynamics? We're talking about insurance. Are we all aware of the cost shift dynamics? Medicaid, what % of cost does Medicaid reimburse providers, roughly speaking? Anyone?
40%.
Bueller?
30%.
More like 65, but good guess. Medicare, fee for service? 70, 75, depending on the efficiency of the provider system. Maybe if you get to MA and you're fully capitated, you're no longer chasing the fee for service hamster wheel, you might get to 88, 89, 90%. But you add all that up, cost of care, reimbursement, gap, where does that go? HP, employers, right? You're not going to duck that one, right? You're going to take that one. All employers take that. The commercial insurers take that on. I mean, that's just a fact in this country. So Sutter Health, don't quote me on this, even though it's a public forum, but roughly speaking, commercial patients are the margin that drives their mission. Not for profit, community-based, several $100 million of unreimbursed care, all comers on Medicaid, all comers on Medicare. You can argue about how efficient they are or are not. You can certainly attack exec comp or different things. Okay, fine. But the basic math is still true. This basic math is still true. There's a cost shift all across the country. And so for employers, it's incumbent, and I think this is where for insurance companies, like why do you go into a JV? You're trying to find a way to help the provider move up the scale and take more ownership of total cost, because that's their only way to sustain their mission. And so that's the big driver behind doing the JV. For Aetna, find a market like Northern California with a provider like Sutter that has scale, and then figure out if you can make scale work. And I don't know that that's been proven. If you look at the headlines, Sutter Health is in a settlement with the Attorney General and the SEIU on that whole lawsuit here in Northern California. You go to North Carolina, Atrium, same experience, 2 years with the federal government. So the providers are trying to figure out, like, how do we figure out how to be consistent and efficient by generating scale? And the payers are trying to figure out, like, how do I partner with that scale as opposed to combat that scale? And that's a big part of why we did the JV.
So a follow-up question on that, does that kind of confirm the theory around Kaiser, which is a very integrated system in which you got the insurance, the medical group, and the hospital system all together, and pharmacy too. So is that where the trend is going?
Well,
is that ideal?
I don't know if it's ideal or not, and I would be, and especially in light of Bernard's passing, who was somebody I super respected and was with a few weeks ago, like his leadership and the vision that they have around the communities they serve. I can get behind that 100%. I've spent most of my career working all around the country. This is the first job I've had in 20 years where I didn't have to get on a plane every Monday. And I've been working in healthcare that whole time. So I spent time in North Dakota. Most of you have probably never been to North Dakota. The healthcare system in North Dakota works differently than it does in Northern California. Same in Florida, same in Louisiana, same in Texas, like radically differently. The forces have evolved differently. So when we talk about these solutions, when you go to the local market, a lot of times they break down. In this market, Kaiser, a lot driven by history, and Southern California largely as well, the pieces have come together in a way that have allowed them to do something that's very difficult to replicate. In Seattle, they acquired Group Health. The underlying sort of, what's the word I want, sort of the structural facts around group health were very similar to what we see here in Northern California. So I think it's a great model. Now, I will say, again, a little biased, married to a practitioner, Nancy Wigginton will go in on a Saturday and deliver a baby that she's not on call for. That's less likely to happen at Kaiser. It's more of a structured shift type environment, which is more sustainable for providers, but maybe not as ideal for, say, an expecting mom. And so there are trade-offs. I wouldn't say it's perfect, but it is a very efficient model, and it's one that has created competitive pressures on people like Sutter to say, wait a second, how do we get close to that lack of competitive friction between the payment and the delivery of healthcare? Because most of that competitive friction doesn't benefit the patient or the provider. It's wasted. And again, the JV in and of itself isn't going to get you all the way there, but it reflects in some ways a competitive response to how well Kaiser has done.
So my question, which is the next question on the table, is how does this JV help the AAA? Why JV, and how does that translate for cost, access, and outcome for the patient? And I would say quadruple helps the providers to not get burnt out.
Yeah, well, we have to get big to really drive that, to be honest. I mean, I think this joint venture is currently focused on the commercial market, which is the lowest utilization market. You know, Medicaid, a lot of unreimbursed ER, a lot of low margin utilization. Medicare, you have older, sicker patients using it. So those are the bigger opportunities, quite frankly. But what it does allow Aetna to do, what it does allow Sutter to do, is get outside their comfort zone. Because the commercial insured population funds the mission for providers. Make no mistake about it. Without an ability to deliver for probably most of you in this room an experience you're willing to pay for and your employers are willing to pay for, they can't cross-subsidize that which they must do in their non-for-profit mission. And so the JV gives them a chance to move forward more quickly and innovate more quickly on things like digital access, you know, free virtual primary care. If you think about it, if you're running a primary care medical group with 800 physicians in it, a multidisciplinary medical group with 800 physicians in it, and you call a meeting like this one and you say, we're going to offer free virtual primary care, most of the physicians in the room are going to say, well, what happens to my office visits? They're going to go down. My income's going to go down. We shouldn't do that. Well, of course you should do that. But those kinds of disconnects in a JV environment where everybody's kind of put their chips in the middle are minimized, and we can innovate more quickly. And then when you start to see uptake, patients are using these services. They like mental health online. They'll go to a walk-in clinic if it's free. They'll go to a CVS Minute Clinic if it's free. And then we catch things we wouldn't have caught. And then guess what? They still come to your office when it matters. And then you can move things more quickly. It's not a short answer, but that's the way it works.
So let's jump over to Abir here. So you've just heard sort of what 2-century-old companies are trying to do to innovate.
I'm not.
And you clearly I'd like your sense or analysis of what they're doing wrong, probably, in your mind, because you're trying to disrupt the space, and and your approach.
So, the way I think about it, and by the way, I'm on the board of the Alina-Aetna joint venture, so I get the dynamic. But if you think about the problem, you got to approach it from the supply side, which is the providers obviously doing the things that they're doing to solve some of the issues that they've had. And you also have to simultaneously come at it from the demand side, which is really where we play. So I don't necessarily view that as conflicting, but it's more complementary. And the way that we come at it at the demand side is by saying, look, the supply chain of the demand side, if that makes sense, is broken of insurance. So if you think about it, the insurance company, which is really producing the product, who's the customer? Well, if you ask a layperson, the customer is the consumer. But for the insurance company, the consumer is not the customer. The broker is the customer. For the broker, the employer is the customer. And the consumer just happens to be an audience, a captive audience at that just gets dragged to the table every October, and you pick out option A or option B. So all of the ability of the consumer to exert choice right away has been taken out. So what we say is, well, let's shuffle the deck chairs a bit, right? Let's put the consumer at the center of it. And the moment the money changes hands from the employer to the system, let's squeeze ourselves right in there. And then that's the $10,000 or whatever the number is, the employer says, okay, now it's going to the consumer. And now the consumer has the power of the purse. So they get to pick the things that they want. And the next year, if they didn't like what they wanted or what they got, they can just switch. They can go to a different plan, a different provider. So why doesn't that work in the traditional model? In the traditional model, if you think about, again, the incentive structures, the insurance company wants to sell more stuff. So they give brokers all sorts of incentives, which is the dirty little secret, by the way, of that supply chain. And the brokers will, if you sit in a broker, and there are good brokers out there, so I'm going to pick on them for a bit. The first question they'll ask you is, what's my compensation for this product? And if you don't pay a high enough compensation, it may be good for the consumer, but it's never even going to get to the consumer because the broker's not going to present it to the employer. And the employer now is trying to save money, reduce administrative costs, et cetera, and the poor consumer just wants to be healthy, and if something bad happens, they want someone to pay for it. So the traditional model, the system of incentives is just broken, and we are trying to change that by aligning everybody's incentives with that of the consumer. And we believe one of the main ways you do that is by giving the consumer the power of the purse.
You brought up brokers and waste, so I'm curious, where are you eliminating the waste? What are you eliminating to finally deliver a more reasonable product for the consumer?
So I wouldn't necessarily call it, it is waste, but I don't think of it as waste. I just think of it as a non-rational purchasing process. So the way that health insurance bought is, you have a consultant, the consultant has a relationship with the benefits manager, they go out, they play golf, they have drinks. It's all relationship-based. And the reason it's all relationship-based, it's a super complex purchase, and nobody understands it. Even insurance companies really don't understand it.
So you're getting rid of all the golf games and...
Yeah, partly, and some wine sales probably go down. But so what we are doing is making that purchase decision a little bit more rational. And by the way, the reason, it's not because people are bad people that they're buying because of golf games. It's because absent any other way to get signaling, relationships is what signals. So the HR person trusts the broker or the consultant and says, okay, whatever they're saying, I'm going to buy that. What we're saying now is give it to the consumer, which is, by the way, even worse because it's so complex, no rational human being should know all of the insurance arcana, but that's where Gravy comes in, where we are the quarterback, if you will, the administrative quarterback sitting on the consumer's shoulder, if you could picture that. And as they're going through their healthcare lives, we're helping them make better decisions. Better decisions about what care I purchase, what insurance I purchase, all the way down to actually how and when I can go and get that care. Now, we're only in year 4, so it's not all done, but that's essentially the idea of Gravy.
So isn't it a fully insured plan? It's basically a fully insured plan, so how do you, and you sell to employers though, right? So how do you make that even cheaper for employers?
For a self-insured employer, yeah.
So let's get away from this fully insured, self-insured for 1 second because it's going to get confusing otherwise, but when the employer gives the employee the money and they come to our marketplace, think of our marketplace as staffed and populated by all sorts of products, okay? They could be from Aetna, it could be from United, it could be from Blue Cross. And when we first started out, that's all we had in the marketplace were other people's products. And the idea was that, hey, the insurers are going to keep innovating, and as they innovate, we'd be a great distribution to reach the consumer. We sell to the employer, it's true, but the employer just says, here's the money, the employer is now a co-financier. They don't have any further say in what products the employee is actually going to buy. So it's almost like we're telling the employer that what you want to do is write the check and get out. Don't get in, don't invest in wellness programs and all of those things, which you certainly can do in a different model. In our model, the employer just says, I'm getting out. I'm going to give money and I'm getting out. And now I'm going to help the consumer, I being Gravy, make all the decisions that will make their healthcare life better. So when we started out, it was products from everybody else. And one of the things, if you just think about it, for the first time, we have longitudinal purchasing data on health insurance, which has never existed before because the consumer doesn't buy health insurance normally through their employer's money. So that data showed that there's tons of areas where there are huge holes in the product portfolio. What I mean by that is if only we had those products, consumers would happily buy them. I think Sean is kind of addressing some of that, which is, health insurance can almost become unusable. A $10,000 deductible plan is really not insurance for a lot of people. And by the way, the insurers weren't innovating as fast as we'd like, so we actually started our own insurance company a couple of years ago. So now, not only do we sell other people's products, we also sell our own products. So in a way, if you, again, extending the analogy, if you go down, Walgreens, you can get Listerine mouthwash, or you can get the Walterine mouthwash, or whatever they call their mouthwashes. So we have our own store brand products as well, and people can choose, and we help people sort of make the right decisions. Do I buy United, or do I buy Gravy?
So follow up on that question. If you are essentially exchanging money with the employer, it looks like a fully insured program. How are you saving cost or minimizing the cost trend?
Yeah. So for the employer now, they are in complete control of the slope of their cost curve, because they're going to the defined contribution approach. And maybe it'll help to understand, if you think about when employers were administering pensions, they were essentially guaranteeing a return to their employees. But when they went to defined contribution 401ks, all they said is, I'm going to give you this much money and let the market do what it does, and then Fidelity will help you figure out how to maximize that. That analogy is imperfect, but it does translate over. So the employer now can say, it becomes a compensation discussion. Do I want my year-over-year trend to be medical trend, which is 8%? Do I want it to be inflation, which is 2%? Do I want it to be as fast as my profits are growing, which is 15%? And every employer will make their own decision. But it's a different question than my rates just went up by 15% or 20%, and now how do I pull all these levers of deductibles and formularies and all of that nonsense to reduce that cost, right? So from a pure employer standpoint, they get to pick their cost. So now the question is, how do we not prevent this from being a cost shift to the employee?
Yes.
So then the consumer then takes the money, and then they figure out, what do I really want to buy? And how do I not pay for the stuff I don't want to buy, but pay for the things that I really do like? For instance, when an HR manager, and I'm going to give you a pretty arcane, so bear with me for a second, makes a health insurance decision, with that one decision, they want to make sure that everybody's needs are covered. Mm-hmm. So they want to buy a wide network, very broad formulary. So everybody needs to be covered under that one decision, right? And there's an option cost embedded in that. As a consumer in Minneapolis, by the way, there are tons of people from Minneapolis, but I live in Minneapolis too, I don't care about having Sutter in the network, because I'm not going to be sick in California, hopefully not today. So
if you are, you're in trouble.
But I do care about having the best hospital system in Minneapolis, which happens to be Abbott, Northwestern, and Allina. So I'm okay with buying an Allina plan that is actually pretty cheap. I don't need to buy the Blue Cross plan that allows me to go everywhere, but it's more expensive. So I'm making a trade-off right there on access, but I, the consumer, am making the trade-off based on what serves my need. And that applies in not all areas, but there are various different ways where aligning those sort of incentives helps the consumer lower their own cost.
So your solution then is much more hyper-local in a way, because then you're not buying in a bigger network. What if you're traveling and other things? Those become kind of an outlier situation. Is that
almost every network will have, that's problem thankfully has been solved by the industry, where they have reciprocal arrangements and so on in an emergency situation. But I will say one thing that is not necessarily local, because you could also have a kid that's somewhere else, or you're maybe traveling, so you may want to pay a little bit more to get that access. But the point is, those trade-offs are very explicit. They're not implicit trade-offs.
But can I just, one comment on that? I think that is one of the challenges for certainly large employers,
Yes.
multi-sided employers, is that the delivery of healthcare is highly local. So to your point, if I'm in Northern California and I get sick, I don't actually want to go to Kaiser.
Yeah.
I love Kaiser, but I'd like to go to Sutter. I have a specific set of facilities I want to go to, and I'm willing to pay for that. If I'm in Minneapolis, I want to go to Alina. These networks, and as I mentioned earlier, these local markets are highly, highly localized. It creates a huge challenge for employers that are trying to make, you have a benefit staff of 5 for 5,000 employees or 15 for 50,000 employees. And so it's incredibly hard. I love the innovation that's going on, make no mistake, but it is challenging for the high margin buyers of healthcare to tailor their strategies locally. And I know for my colleagues at Aetna, they own half my business. They have 5 joint ventures. They have 80 ACOs, which are sort of that's like getting coffee. Joint ventures is like getting married. They have 80 ACOs where they're trying to approximate this kind of alignment where the provider and the payer are not fighting each other. But generally speaking, it's a challenge right now. I'm pretty confident, though, that localization aspect, given the benefits of technology, will advance, and you'll be able to do more of these micro networks. We're not there yet. I think Gravy and other companies are taking us in that direction, but the sort of multi-sided problem really creates challenges for the employer segment.
I'd like to bring Jana into this and have her answer the question about localization and how you're doing that at Anthem.
Well, we firmly believe that healthcare is delivered locally as well. And I think that's one of the beauties of the Blue Cross Blue Shield system, is that there are a number of Blue Cross Blue Shield entities that have presidents and CEOs in each and every state in the U.S. That's part of the association rules. And so as a result, you have local network people in local markets that are very familiar with the local provider groups, the ACOs, the independent, primary care physicians. And it is based upon those local relationships that we actually develop the network. Anthem only operates in 14 states, but we leverage the other 36 state expertise to construct our national network. So we're firmly in the same court as Steve.
Do you so coming to Anthem in general, what are the innovative things that you're doing? Because Anthem has so much data that's coming through from diverse states, diverse needs. What are you doing innovatively that helps make sense from the data today to help you to engage with patients? Yeah,
I think that's a really good question, and I think I'm going to kind of pull in a common theme that we've heard around sort of eliminating the waste and making it easier for members. If I look at the construct of the individuals that we're hiring today, they really come from a consumer background and a ton of tech and digital people. We have hired a number of really smart people from companies in the Silicon Valley that are really leading us to be what we call a digital first organization. And that's really leveraging technology and starting with the base stack and then looking at the different constituents that we interact with on a regular basis, whether it's brokers and consultants, whether it's providers, whether it's members, whether it's employers, and completely transforming the way that we interact with those individuals. We're highly reliant on machine learning and artificial intelligence, and in some ways, social determinants of health as well. So if I can, I'm going to take you kind of through a member journey and show you how we're kind of applying the social determinants, the machine learning, and the AI. So it starts kind of with our analytics, and our analytics power our providers, they power our service advocates, it powers our clinicians that are working with members, and it also powers our digital platform. So historically, we leveraged retrospective data. So think about a claim that occurred in the past, an HRA that was filled out in the past, or biometric screening that was done. Could even be close to a year ago. What we started to do about 3 years ago is layer in, as I said, social determinants, very, very meaningful, and very much of a determinant of whether somebody could be expected to have a certain clinical condition based on the specific zip code. Layer in machine learning and AI, and we saw some astounding results. We were identifying individuals on average 63 days sooner. That's significant if that individual becomes a high-cost claimant, because you have the ability to start to interact with them and potentially direct them to a high quality but lower cost, facility. Also, what we learned is we were getting in individuals who were becoming emerging risks versus those that were at risk. And again, you have the opportunity to modify behavior if it's an emerging risk. So let's say that we identified an individual who was an emerging risk diabetic, and they happened to take a call from an Anthem clinician that reached out to them. Well, the first thing they want to know is, what are my covered benefits? So they call into customer service. So customer service now, we are powering them with what we call an associate assist AI. So when they ask about benefits, their screen is automatically populating and scrolling what is their deductible, what is their coinsurance. AI machine learning is anticipating the next question is going to be, how much have I paid towards my deductible and coinsurance? And so it causes for a much better service advocate experience because the data is right there, and it's a much better member experience because they're not having to put the member on hold to go to the screen to look up the deductible and the coinsurance. The advocate sees that the member doesn't have a primary care physician. So they co-browse with the member to try to find them a primary care physician. Well, now in our provider search, we're also applying that same technology because I think you said it earlier, Sean, not all doctors are treated equal. And so there may be a primary care physician at Sutter that is really good at treating diabetic members, patients, where their HEDIS scores are really high, but the doctor in the office next to him is not really good. So in our search, we're being smart in presenting to that member that's the newly diagnosed diabetic, the most efficient provider that treats diabetes. The concierge tells the member that there is a digital platform that they can interact with if they want. So we're applying machine learning and AI to the digital platform so that we push the most appropriate content to that individual, and then based on how that individual continues to interact with the system, we're machine learning and recognize that if we push a message this way, they're not going to answer it, but if we push it that way, they're going to answer it. And then we have introduced Member Assist AI in the digital platform. So just like you can with other websites, you don't really have to wait for somebody to respond to your chat. The responses are automatically coming up, and that's based on AI and machine learning. And then the last thing I would say is on the website, we have what we call a symptom triage tracker, where you can fill out sort of a decision tree of questions, and that's all AI machine learning based. And then at the end, what will result is the appropriate site of care, and then help direct you to that appropriate site of care. So you can see that kind of all through the member journey, we are deploying technology to make it much more efficient, a much better member experience in ways that you wouldn't. We don't think of ourselves as an insurance company anymore. We're really kind of, a digital first entity.
And you definitely made that case for sure.
Oh, okay, good.
Jonna. I do want to bring in Michael, so we can then open this up. So Michael, clearly Anthem and Jonna very prepared to let everyone know that Anthem is not sitting back, and they are a tech-driven company first. And you and I have had conversations, and by the way, OMERS is a $1 billion VC, correct? $1 billion under management. And you and I have had conversations about these new insurance companies. Are they really, how different are they? They say they're tech-driven, but as Sean's pointed out, no, they're just adding a customer service layer. In the case of, say, Oscar, which I love the company, but That's just an example, but there's Oscar and
Clover.
Bright Health and
Yeah.
Clover.
Yes.
So as you think about these companies, and I think you have some reservations because you haven't really seen there's nothing there yet that they've been able to prove out. Now they're early, but what are some of your reservations as you look at these new healthcare insurance companies, and what kind of questions do you ask these companies before you actually write them a $50 million check?
Yeah, I mean, I think in this whole category, everyone loves to jump to tech, frankly, as kind of like the silver bullet or the answer. And of course, you know, sitting as a VC, I love tech too, but I think you have to really scratch underneath the surface to really understand like what's at play here. So I'm going to answer your question. I'm going to start with a couple of things that I haven't heard anyone say. One is trust, and one is like, what is the front door? So I think the overall arching battle that everyone on this stage and everyone in the field wants to play, it's like, who wants to be the front door to ultimately the consumer, the patient, whatever constituency that you're the employer, who the provider, the payer, like it's a battle for the front door, and everyone's trying to go after that, okay? I actually think whoever has the most trusted relationship, that's going to be who wins. Is that trust enamored through money? Is it trust through access? Is it trust through technology? Like that still needs to be figured out, but I think people are coming about it in many different ways. I think it's hard for a de novo venture-backed health insurance company to compete with the big guys over there because so much of the game is ultimately about scale. And what we haven't talked about is really go-to-market sales. I mean, national accounts, like the army that these guys can really put into place, whether it's locally or on a national basis, that is really, really tough to kind of compete with. And that's why you have to be either hyper local as one of these startups, and that's why you see them kind of picking off certain geographies that they're going to go do that. I think the other thing is most of the founders that are going after health insurance come from tech. They actually don't come from health insurance. So they are learning on the job half the equation of what they're competing in, and that just leads to a lot of waste of venture dollars as you're kind of funding their kind of education, right? So you can kind of really quickly figure out in like 1 hour whether or not they know health insurance or they don't know health insurance, and it usually takes a couple years before they actually start to hire a bunch of health insurance people into their business. So you're hiring tech people into your business, they're doing the opposite, and it's just kind of like a swap of talent between the two industries.
Well, what's interesting is that we did poll everyone, so about 150 people filled this out. And we asked in 10 years which companies will have the largest market valuations. Was it going to be the new insurance startups or the incumbents? What do you think? How many here think that the majority said the new startups? And then the rest of you, then how many think the incumbents? Okay, it was 70% believe that it was the incumbents. I don't know if I necessarily believe that, but that's what the survey
Well, I would
said.
just say, like, Aetna will not look like Aetna. Like, I meant, you know, again, and this is a friendly environment, but Aetna's logo color is purple. CVS Health's logo color is red. It's the sort of a heart, if you've been to a
Yes.
CVS. My prediction is that 5 years from now, there will be very little purple. So I think the definition of incumbent, I think, will change. I think to the point around front door, it's an excellent point. It is, when we think about our business strategy in my little business, what we're trying to balance is Stanford and Sutter and all the physicians that work there and their pensions and their profits and their education and their training and their expertise and their belief that the primary physician-patient relationship is paramount to great health care. And we're dealing with a lot of new constituents and consumers who don't necessarily share that belief, at least not yet. Not at 28, not at 34. And their front door is defined differently. And yet, for employers, you have both 48-year-olds and 28-year-olds, and how do you provide a front door and a benefit program that's blended? It's quite challenging.
Yeah,
So,
I mean, I think we brought that up in the beginning,
Yeah.
is that I said, from what I can see is that, you're really bringing in the tech to build that trust, doing a ton of things, but ultimately it's to build that trust. But because, well, first of all, I don't think insurance companies ever had that trust because they were never that connected. But back to Michael, just with regards to investments, one of the areas, so that's, you're kind kind of skeptical about the healthcare insurance companies, but what you are interested in is investing in some of the companies, some of these new companies that may sell, so these new benefit type of companies, but they haven't done so well. So first, I will ask you, what you're looking at there, but like, let's say, for example, Livongo, right? One of the companies that just went public. And I think the journalist brought this up about in terms of retention, great retention in the beginning, they're getting all of these fabulous customers, and then they drop off, right? So that's got to be a concern for you as an investor when you're looking at these companies. How do you feel comfortable, or what do you ask yourself in terms of how do they get to, they're going to get those customers, and then they drop off, and that's something you actually won't know, right?
It depends. I mean, you gave. You're pointing out diabetes in effect, right? And that's a point solution, in my opinion, right?
Yes.
So first, I'll say what I'm investing is primarily what I would call over-the-top solutions, primarily sold into the employer market, because Steve said that's a commercial market. That's over 50% of the lives in America, and that's where most of the money basically is. Okay. You can do techniques like what you're doing to kind of manage that, but where I have particularly spent my time is really at the jumbo, kind of the largest employers kind of in the country, and kind of what's in their mindset, what tools are they looking for, and all that. And I think they very much are looking to empower their employees, but in a different way. There's no literacy in this space, okay? So I think there's a presumption that all of you guys have said on stage is that the consumer, the patient, the member, the employee is actually literate, and therefore if you empower them, they can actually make the right decision. I would actually say they are not literate, and actually what they need is more of a managed service or a curated set of hands that it's gonna take them there. I believe in the paradox of choice, and I think choice in this business is actually two options, frankly. So you almost are better off just giving them one option, or at most two, and then kind of making sure they take advantage and maximize all the programs and the initiatives that have kind of been deployed in that plan. I think the other thing is, and we got to this a little bit, social determinants of health plays a lot into literacy, because frankly, if you're fighting other fights, you're not even a healthcare consumer, right? Like you're not even at baseline zero to participate in all the great things that these guys are offering. So you're at a deficit, drowning to just get to the top of the pool in order to kind of figure out, do I do this, and this, because you've given me all these tools to do that. So a lot of my investment thesis is, frankly, because you've heard me talk about navigation, advocacy, and in the things that I'm investing in, which are tech-enabled services, it's fundamentally because either the providers or the payers have abdicated that space. They're not filling that role, and therefore that's allowing startups that are venture-backed to kind of come in and step in. Now, to your question, I would say there's been kind of a Cambrian explosion of vendors or startups trying to
keep it close.
Okay. that are going after this whole kind of opportunity, and that has led to too many point solutions. I'm doing diabetes, I'm doing smoking cessation, I'm doing fertility, I'm doing a telehealth consult, I'm doing a second opinion, I'm doing price transparency. I mean, you're just solution deathing kind of the entire food chain that, from kind of brokers to consultants to ultimately the end consumer. So I think the big gap or the big need, frankly, in the space, which is kind of a reversion to the mean of what a health plan probably should have done originally, is aggregation and platform and kind of stitching that together. So I think that whole business is going to be evolving to what is the engagement that Livongo is seeing, whether you call it retention, I call it engagement and utilization, and there are third-party services that employers are buying to help Livongo get that engagement and utilization while Livongo's also solving it, because I think Livongo has demonstrated it works, right? If you are on it and you stick to it, you will deliver cost reduction and clinical kind of efficacy for the benefit of the whole system.
Well, and you kind of nailed it for the employers, definitely, because it is most of these point solutions directly coming to the employer to try to make decisions when when this is laid out to the end user, which is really the member or your employee, it is very confusing. And it's hard for them to figure out in this marketplace what is truly applicable to them. And so we, more and more employers are kind of moving into the one front door space, and how do we work together with each of our vendor partner ecosystem, so to say, so then we can actually have that point of contact go through that one front door. In the back end, all of these point solutions could be stacked up. And then there is the health literacy aspect that you talked about. There is one that is the social determinant. Could be like somebody who truly, was hardship and kind of socioeconomic. But then there is this, high-performing individual executive flying across countries who wants the doctor to just take them through the journey and not have them make decision. And it's like, you tell me what to do and I will do it. So that you can see both outliers almost at the same level of not health literacy, but health advocacy for themselves, that is hard for large employers, even Medicare, to solve for that. So when you're investing, are you looking at health insurance as a big industry and then you will invest, or you're breaking it into pieces and looking at attributes of problem solving in those?
I'm looking at spending time with folks I'm spending time with customers, right? In this case,
yes.
The enterprise customer is actually the benefits, the HR, the CFO, and all that kind of stuff. And just saying, what would you like to buy? What are you buying today that you would rather not buy? And just kind of figuring it out from there, right? Because ultimately, I'm trying to fund a business that kind of sells software, services, hardware, whatever you want to call it, to them, that kind of reinvents kind of their current landscape.
I want to touch on this whole there seems to be a debate here, because I see Abir and Sean kind of shaking their heads, and this is kind of, we're moving in a world, and by the way, I think, with all due respect, I think, the employees of HP versus the employees of Facebook, they're kind of a different demographic. So we're not really talking about let's talk about the new demographic and their new demands. And I think the way they engage with, or the way they will increasingly demand how they engage with their health services, they will become health literate. And I think one of the reasons why there's this illiteracy is because, well, you never gave them an option in the first place, or choice. So I'd like to hear from Abir and Sean, or maybe Sean, because Sean's been so quiet, that you were shaking your head when Michael was talking about how, we have to limit the choice for consumers.
Yeah, so earlier, I think if you would ask me, I definitely believe that we don't have a literacy problem. None of you have a literacy problem. You have a really shitty benefit that makes you illiterate when it comes to using your benefit.
But
Right.
I'm sorry, I got to interrupt you. There are people who are old, who are mentally ill, who have cancer, and they can't self-advocate. You could give them the best plan possible, and they can't even read the paper. I mean, you have to have an advocate. Yes, it helps to give options, but to say we're all literate, this isn't the normal population. I mean, this is Silicon Valley at HP. Of course everyone here is literate.
Probably normal. Sure.
Talk about the masses.
Sure.
That's who needs help.
Yeah, absolutely. And so I would say, yes, part of the masses is what you're describing. But the masses, I would argue, have the ability to make decisions. Right now, they're given a benefit product that is indecipherable. You can't make a decision. You don't understand the product. You're not given information. There's no way to know a price, because I go to a transparency site at Sutter, and Sutter will tell you, I give you here are prices for the 50 most used items. Here's the average price. But at the end of the day, you need to talk to who to get your price? You need to go talk to the insurance company, because it matters, your benefit matters. You flip over to Sutter Aetna's.
The joint venture.
Yep.
Yeah, joint venture.
You flip to the joint venture, and the joint venture will say, here are average prices for things at Sutter. But at the end of the day, it depends on what happens when you go to Sutter. It depends on what happens in the room and what's coded.
It actually depends on whether you're a self-funded employer or fully insured, because if you're self-funded, it depends on the benefit plan that your particular self-funded
Yep,
employer
so now
has
I'm in a
implemented
circular loop, because now I have to go
versus
back to the
fully
payer,
insured.
right?
Yeah.
Indecipherable when you have elements like co-insurance and deductibles in place. Non-frickin' sensible. Eliminate them. People understand prices. Elderly people understand prices. So when we look at the usage of our digital tools, the digital tool rate hovers around 80%, whether I'm talking about people that are in their 20s or we only service the commercial market, people in their 60s. So when you give them information, I'll just give you a stat on this whole literacy thing. So prices hold in our benefit regardless if you're shopping for your script or you're shopping for an office visit or a surgery. Everything has a price. So we had, in one enrollment period, we had, in our first one, we had 10,000 people that were entering into a new product. That product had a new formulary, which means in January, we have, out of 10,000 people, what's the most utilized thing in January when you're switching a new plan? Scripts. So we said, okay, we need a plan for script usage, because we've got a whole lot of people in a disruption event. Something's changing for them. Their formulary is changing, and the network, the pharmacy network's changing, because they're on a new PBM with a new benefit product. So we went to our administrative partner to say, we have to prepare for this. How are we going to prepare our call centers for what kind of volume? And they said, based on our 15 years of doing this, you need a plan to get 624 phone calls. So we staffed for 700 phone calls. We had, anyone want to give a guess how many phone calls we had? See, if people are literate, how many should we have?
0.
How about 24?
Yeah.
How many searches did we have digitally that got their questions answered? Because they're literate if you give them the right information.
And the advice just happens to be targeted at a healthcare problem. But I would submit to you that I don't think I don't think there is a choice. What I mean by that is healthcare trend, healthcare inflation in this country is going to be 8 to 10%, is expected to be, could be more over the next 15 years. GDP growth is about 2 to 3%. Those two curves are going to create a problem for every company in America. That's just a problem for the real small ones today, which is our customers, where we see people dropping healthcare coverage altogether because they cannot afford the floor that's needed. But it's going to happen to all the companies. It's just a question of when. Now, there'll still be companies still have pensions today. Not everybody's gone to 401k. So there'll still be companies that do the traditional model. But even beyond, why does the employer have to be that advocate? Well, it's because of tax. When an employer buys health insurance, it's pre-tax. When an individual buys it, you buy it with after-tax dollars. This was in the wage controls of the 50s. Well, guess what? That's just changed. Starting in January 2020, when an employer gives you money to go buy your own health insurance and your own health care, that's pre-tax too. I saw somebody, I think you had the ICHRA on your, which is, kudos to you for putting that. But that's the vehicle, do you want to care to take a guess at what the ICHRA stands for? It's a long acronym, and I can't remember it myself. My co-founder will. But it ends with a health reimbursement arrangement, which basically is an account that an employer can fund pre-tax for you to go buy your own health care. So I think the world of tomorrow looks different than the world of today. And the reason is because the employer is not going to be able to afford to be the aggregator of demand that it has been in the past. And our premise is, and when the employer abdicates that role of being the aggregator of demand, somebody else needs to step in, and we hope that'll be us.
I want to bring the employer in the room here into the conversation. When he talks
I'm
about
hosting it.
I know, but when he talks about getting the employer out of the equation, what comes to your mind? I mean, do you want that control?
Well, I think the self-insured model that is vastly lower in cost for an employer than a fully insured model, because the administrative cost and planning for risk and covering the risk pool it adds up to the cost. And what Gravy's talking about, or what you're talking about, Beer, is that you get out of the way, we'll manage the cost. It works really well in a 401k where it's a retirement is your end point, but it doesn't work in healthcare as linear when your health is the end point. And there could be, during that journey, there could be cancer, accidents, all of those things, catastrophic events can happen. And that risk needs to be accounted for. And then, being a large employer, which which today, I am, but smaller employers too, we have to plan or design our plan design for the extreme cases. We cannot be designing for a more common case, so we have to think that's what the ideal model is. Like, you design for the extreme cases, it works for everyone.
But the law has taken care of that. So the Affordable Care Act, nobody's saying don't buy insurance. Goodness me, you got to buy insurance. But when you buy insurance, any insurance, and by the way, self-insured, fully insured, that's just a way to pool the risk. It doesn't really matter what the underlying economics are the same.
The cost point is very different, though.
Not necessarily. I mean, it depends on which part of the country you're in. But self-insured employers, I mean, in the late 90s when we started Definity, we're going through 15-20% year-over-year trend. We're just at the bottom of an underwriting cycle right now, and that underwriting cycle tends to repeat itself every 6 to 7 years. And 6 to 7 years ago, the trend for large employers was 8 to 10%. I know because we were working at Red Brick at the time. So my point is that when somebody buys insurance, the law has already taken care of the fact that it's got to be real insurance. It's not crap, the extreme case, like you said, someone gets cancer, etc. It's taken care of. My only premise is that the employer, and I know it's probably not a great thing to say to an employer, but the employer should not be the arbiter of healthcare, and you are only the arbiter of healthcare because of tax. That's really my premise.
We have 2 questions here.
I mean, we talked so much about the supply side and the demand side, right? What about the middleman? What about eliminating the waste due to the pharmacy benefits managers or the aggregators, the purchasing organizations, some of the brokers you're talking about? What is the innovation happening there to cut down the costs? And I don't know if we're attacking the big problem, kind of like touched on from the startup side, so I'm just curious.
Direct contracting, I think it's still the holy grail that employers, especially the largest one, strive for. I mean, I think that's a lot of the inspiration for maybe Amazon, Walmart, and others that have millions of covered lives, So again, there are definitely some in the large jumbo kind of population who think waste primarily sits with PBMs and with carriers, frankly, and therefore if you can kind of bypass them, since predominantly you're only purchasing ASO, administrative services only, if you could kind of start to do more of that yourself or leverage startups to kind of do that and contract directly with pharmaceuticals companies or contract directly with health systems, especially if you're more regional versus national, then you might have a shot. I think that's tough. I think it's really tough. I'm not sure any of us are going to see that in our lifetime here, but like that is like one model that you can kind of theoretically put out there as a alternative kind of world.
I would say the PBM world, and I'm not an expert on it, but there's definitely a transparency and information arbitrage opportunity that's at play as we speak. And those that part of the industry, I think, will get innovated. I can tell you firsthand, ASO, self-insured employers, carriers don't make money on them, other than maybe a little bit of additional contracting leverage in the markets where they have ASO density, and therefore they can get slightly better rates from the providers and get slightly better margins with their fully insured business. But I've tried to grow our self-insured business by guaranteeing performance, and I'm talking about $300,000 or $400,000 of fees on $40 million of medical expense, which is passed directly through from the provider to the payer, to the ultimate plan sponsor. There's not a lot of margin in this self-funded world.
So if fully insured, we're like a public utility, we're limited.
It's highly competitive, but the point around brokers and consultants, I think I just make a comment there. Again, the large employers with significant populations in multiple geographies, it's a highly complex challenge with a really small staff, and relying on an Aon or a Willis Towers Watson or a Mercer to help you negotiate that, to me, is the same as hiring Deloitte to help you put a new ERP system in. It's just smart. There is a broker culture that's at the small to medium business level that you do see variation. You see high value add and strong value orientation, and you see churn. In the same way you can hire a real estate agent you would hire 5 times over, and one you'd never work with again.
So can I say one thing about waste? So and I'm not shooting arrows at anybody, but one thing we haven't addressed about waste is unnecessary care. So if you look at the healthcare dollar, so go to AHIP, they produce every year, not every year, they update it every couple of years. Where's the healthcare dollar spent? And the lion's share of the healthcare dollar is spent on services and therapeutics. And when you go look at research on service use, and the one I like to use most is actually when they go survey clinicians around the country and ask them, what do you see in terms of unnecessary care in your day-to-day practice and interactions? And the statistics come back and they're pretty startling. So what the clinicians of the country, this is not an insurance company, these are people that practice medicine. Your wife maybe was surveyed here. What the survey,
You probably didn't have time to respond.
what the survey says is over 20% of all testing unnecessary. Is that waste? Yes.
Yes.
And what's and when it's the highest component of the healthcare dollar, probably an area of waste we should be thinking about. So not only is it testing, in terms of scripts, 22% of all scripts they identify as unnecessary. Procedures, 11%. So think about that waste. And then couple it with other facts, like when it comes to a procedure, we have about 50 million people that have a surgery every year in the United States. Every year, of the 50 million, 2 million become lifetime addicts to opiates. And think about it, I'm not saying all surgeries are unnecessary, but if doctors say 11% of procedures are unnecessary, they're unnecessary and people are becoming addicted to opiates as a result, we've got other areas of waste to think about besides, PBMs are they're on to a new game. They've switched from rebates to generic, dispensing spread at Walgreens. But we also have to consider that. So on the waste front, going back to literacy and my belief in people, I would encourage all of you to just do a couple things. Some of you already do it, but your loved ones, when you go to the doctor and the doctor says, do this next, ask them a couple questions. What if I didn't do it? What would happen? Is there anything else I can do? And is there any risk for me doing this?
Yeah.
Then that'll help with waste, the biggest area of waste.
And I would second that, because a lot of levers that the self-insured employers are now using is direct to primary care solutions. So we have an on-site through Crossover Health. We used to have Premise, and then there is One Medical. They're starting to do this, and they are very value-based, ground up. And so now, in 98.62. No, so now, they are reporting against how are they meeting all of the guidelines and how many referrals they made and why were they necessary. How many of the scripts they went out that were off statin, and why was the health coach not used. So there is a lot of these guidelines beyond the HEDIS. HEDIS is like the bottom where you need to meet, the minimum. And then you go beyond it, and now these direct to primary care are managing healthcare in a much better way and decreasing the healthcare cost. Our Crossover Center has, for example, physical therapy, chiropractor, behavioral health, and dietitian on site supporting our primary care physicians. Now suddenly, if somebody gets a back pain, guess who they see? They don't even get an x-ray. They would actually go see one of the 3 providers, including behavioral health, because perception of pain is a thing. Okay, so now this patient has less likelihood to go out for x-ray, less likelihood for MRI, less likelihood to get an opiate or get a surgery or even injection. So this is how most of the self-insured employers are using that lever, and that's kind of a good investment, Michael.
Yeah, I would agree. I'm a big fan of clinics and primary care. I'd go back to waste on the admin side, waste on the MLR side, right? So that's what we're getting to.
Jose, you have.
Thank you. We're talking waste and efficiency here. From the standpoint of waste, the U.S., just Medicare, Medicaid, $250 billion a year on fraud alone, on claims that are fraudulent. So identity management is a very critical thing here. With regards to efficiency, I've been swimming in the European blockchain world for the last 3 years, and we just got back. And my question to John and Steve is, are you guys funding any possible efficiency improvement with blockchain, smart contracts?
In fact, I have a note here. Let me just put my glasses on so I can read it. I wanted to talk about that, actually.
Mike.
Yes. In conjunction with a competitor, Aetna, with HCSC, which is the Illinois, Texas,
Yes.
PNC Bank, and IBM. We have a huge blockchain initiative. The initial focus is really around networks. I mean, networks aren't differentiators, but we all have to keep our own, list of the providers and addresses and that kind of thing.
Private blockchain?
Yes. And then what we're looking to do is to then venture into the member world. And while you have a lot of data in your EMR, there's a lot more data that we can add in, again, so that we can better determine earlier what kind of interventions and where we need to be, placing people. So we have a huge bet on blockchain, and we were the initial ones with Aetna to come out with that.
Excellent. Leslie, you had a question.
Oh yeah, I just wanted to, we've had a lot of concepts flying around here in the conversation, a lot of topics of healthcare literacy and all these different things, and I've been at this for a very long time. I started up the road in medical economics class when I didn't end up going to medical school. And there was a concept that was drummed into my head that I think might help people as they sort through all of this. And that is that in medical economics, unlike regular economics, there's a primary and secondary consumer. So when you take a look at all of this, the primary consumer for healthcare is the clinical consumer, which is typically the doctor. The secondary consumer are people like us. So when we're talking about health literacy, I would really say in your mind, put a parenthesis in there that it's about healthcare financing. When you're talking about coverage, you're talking about Obamacare, any of that, that isn't healthcare. It's how you pay for healthcare. Benefits and coverage, how you pay for healthcare. Healthcare is what happens between the doctor and the patient, the hospital and the patient. And I'm seeing all this stuff get kicked around and everything gets blurred, the lines get blurred. Clinical inefficiencies, wrong diagnosis, wrong tests, wrong treatment, etc. That's the primary consumer, the physician to the patient. The secondary consumer, the stuff that we're drumming into people's head and saying, learn this, and they're resisting for good reason, is having a command of what HSA is versus FSA versus deductible versus coinsurance, all of that. People are like, their heads are exploding, right? They don't really want to know all of that. They just want to know, to your point, what am I going to have to pay when I go get care? And for that, yes, every single health insurer has a cost estimator. Every time you can get on, you can try to figure it out. Is it perfect? No. Do you sometimes have to get on the phone with the billing office, et cetera, or wherever, and have them help you figure out in advance what it might be? But it's really important, I think, to separate that when we reform healthcare with minimum essential benefits and insurance terms, that isn't healthcare. That's how we pay for healthcare.
Mm-hmm.
Well said.
Yes.
Yeah, I think that's a really good point.
Yeah.
And maybe if I can just build on that one more, it's, when we talk about healthcare financing, it's almost like you need a layer of translation where gobbledygook comes in and real, understandable English comes out of the other end. So the question is, in our minds, is who should be that layer of translation? And I would submit to you that the person that should be in charge of that translation should be the consumer's agent. And they should be wholly incentivized to do things that are good for the consumer. Not for the employer, not for the broker, not for the insurance company, not for anybody else, but the consumer. And creating a business model that enables that will earn the trust, which ultimately leads to the front door that we had talked about earlier.
So on that front, the survey that we did, more people actually trust their employer insurance than any other type of insurance model that's out there. And there's a reason, most people do trust their employer.
Can I say something about that?
Sure, and then
I know you want to get to a question. Most people don't
yeah.
realize that their employer is their insurance company. I spent last week in one of your favorite flyover states, Missouri, conducting several open enrollment sessions at a Fortune 100 telecom. And when I shared with them that you're all purchasing this together because you are actually the insurance company, you with your employer, and I got what? Are you serious? You're not the insurance company? No. So I think that maybe this group is a little more knowledgeable. The average American, go back to the average American, no freaking clue that their employer is their insurance company.
Yeah.
So the trust component, no one trusts insurance, whether it's their employer or us. I mean, that's the truth today. No one trusts insurance.
Okay. Yes.
Thank you so much. First of all, I want to definitely express my gratitude and thanks for the depth of expertise on this panel. The quality is quite good. I'm a founder CEO of a talk therapy application for mental health, and we're using voice biomarkers to measure and predict well-being. We've been surprisingly shocked with how much insurance inbound there has been. And so as an engineer, I would like to better understand how insurers kind of think about purchasing and how I should be thinking about prioritizing those types of efforts.
Yeah, as the point solutions are changing now, the buyers are becoming more insurance companies then. Yeah, so how are you thinking? Yeah.
I mean, I'll take a first step. We're talking to Meru, Lark, Ginger, Able to, Joyable. I know there's 4 more. All of them are telling us we're the one. Because we're a joint venture, we don't have to listen to Mother Etna or Papa Sutter, or however you want to characterize them. Both of whom are doing a lot around mental and behavioral health, make no mistake, but we're wanting to push into the areas that sounds like you're innovating. Our approach is, let's not try to choose, let's try to test. Can we contract this as a claim? Can we make it easy to plug in? I started 7 or 8 months ago saying, what if I have a budget to just buy this stuff and give it to our members to see what works? The insurance laws make that difficult. High deductible health plans make $0 copays impossible. Are you familiar with the IRS regulations of high deductible health plans? There's all this brain damage. You want to do the right thing, it's really hard. That said, given sort of the parental latitude that I have, we're basically trying to figure out what can we plug in that our members can take advantage of. One of our advisors was with Cisco for a period and is back with Aon. She did 9 months of research and looked at 12 or 15 firms, and her recommendation was make as many of these options available as possible as a straight paid claim, no brain damage for the person, member, patient, pick your term, and see what works. And so that's the approach we're taking. And the woman who runs our network in clinical performance area is Nicole Brooks, and you can reach out to her.
Yeah, we, Lark, Ginger, My Strengths are the entities that that we work with or we are talking to. I think you made a really good point, and that is the reason that I see the drop-off in the Livongos of the world is that it's not integrated. It's sitting out there on its own, and people need to wander their way in to find, find out about it if it would be of benefit to them, and it's not sort of integrated in that member experience, which is where I think these advocacy solutions, whether it's an independent advocacy or advocacy driven by a health plan like we have, and by the way, our NPS scores are in like the 70s with our advocacy thing. So we can now compete with the independent advocates, but unless it is clear that these advocates, these advocacy layers, understand who these partners are and the role that they can play, and that it is incumbent upon them to connect the right member to that resource because an HP has invested in it, then it's not going to work. And that's why I think for some of these where you don't have that advocacy platform layering on top, you see the petering out effect.
Yeah.
We hired a company called Docent based in Boston to build effectively you don't have to figure out where to go function. The current working title is navigation, which sucks. But the idea is you're just trying to open up options and then see what works and then push them. And so there's a lot of openness. The other thing I would say for your business particularly is what we hear we operate a business in 16 counties in Northern California, so it's a tiny, tiny little market area with only 7 million commercially insured members. And so we have a small footprint. And what we're trying to figure out is what works in that market, what can we plug in, and then how do we make it seamless for people to kind of find it. And then when it works, the big push we get from our employer customers, it's a high priority in the peninsula. When I go to Yolo County, it's not their number one objective. It's price. It's defined benefit, actually. In Yolo County, they want defined benefit. In the peninsula, they want, I'm trying to retain high quality talent. So it's incredibly complex to figure out what works. But I would say you will find a lot of uptake around mental and behavioral health that works, and just finding those footholds where you can prove it, it will definitely gain adoption.
I just want to give a time check. It's 8:25, so we're 25 minutes over, but we wanted to extend this to 5 more minutes. So go ahead.
Well, hopefully this is a question that'll kind of pull together a lot of the themes I've been sitting on this question. So I'm a behavioral health clinician, but I'm also an engineer primarily. And mostly with patients, I help as a medical advocate in decision-making around really intractable conditions, cancer, severe mental illness, etc. And I just want to say, for those consumers of healthcare, it's not about the service, it's not about price, it's about who should they see. It's not about the provider system. They want to know when they come to support groups, who's going to be effective with my situation. And one thing I haven't heard anybody talk about tonight is a future of healthcare insurance that gets rid of the idea of networks. So you're really talking about how to match patients to a clinician. That's how patients think. At least the cohort that I work with, cohorts that I work with.
Networks.
So why don't we talk about that?
Well, I mean, I explained a little bit earlier, our toe in the water was around primary care. So understanding those primary care physicians that have the best, panels, have the highest quality standards around certain disease states, that really just, the start was around primary care, but it's certainly going to extend, particularly to in the national account space, those cost drivers that we see consistently: behavioral health, oncology, musculoskeletal. So those are the next areas where we're going to explore doing that match between a member and all of that information that we know about that member through AI, machine learning, the clinical conditions, all that information on them, social determinants. What's that best match with the providers? So that's the future.
I would just say it's incredibly hard to do what you are expressing, even though it's exactly the right thing to do. Because if you look at the provider networks, they have consolidated. Physicians are now owned by health systems in most of the major markets. And if you make a determination, I say you, I'm stepping out of my current role. If I said I want to pair you with the exact best physician to treat the condition you have, that physician's contracting, pricing, schedule availability is largely no longer in their control. It's not. It's enterprise controlled. And so it's a really challenging problem to solve, because the insurance has driven the sort of rate negotiation discussion. The providers have driven to, I'm going to consolidate and protect my revenue. Nobody's addressed the cross-subsidization that I mentioned earlier. That's not been addressed. And we're not living in a bubble here, right, with employer-sponsored coverage only. Our providers, my wife, who, by the way, doesn't get compensated for a much lower C-section rate because she's in a group. She's in a group. She gets the same as the 6-year experienced person that sections at 6 so she can get home for her 6-year-old's dinner, okay? That's the reality at the provider level, and it's incredibly hard for us to crack that at scale. I love these innovative local businesses that are figuring out, for local employers with concentrated employees, how to crack that nut. I love the primary care models that are saying, on behalf of a large, diverse population, how can I avoid the crazy mismatches where someone goes to a back surgeon with lower back pain? Great. But at the level you're operating, it feels really hard to get there. It's heartbreaking, honestly, but it's really hard to get there when the providers are consolidating to try to protect their mission in a not-for-profit way that they believe deeply in. These are not bad people. You know, they believe deeply in what they're doing and the benefits of scale. And when you want to go pick out 5 physicians out of a 20 or 30 physician multidisciplinary group, you cannot do it. You cannot do it.
But so I'm going to question on the solutions that we do have available, like Grand Rounds, which does do some level of expert advisement. So let's say if this patient, we pick a patient with knee problems and needs a knee surgery, they can actually go to something like an expert opinion at Advanced Medical Grand Round.
Second MD
and get a
is
second
another
MD.
one, yeah.
So they can get a second opinion, and that report is sent to the doctor. Yeah, you can't go to that doctor because they are sitting in Cleveland, but you can still see them here with the report that gets back to them. That can influence the outcome and the decision making for the knee surgery.
Absolutely.
We have a future of healthcare insurance that gets rid of the idea of networks and contracting. That's what I'm curious about.
I think I'm a little bit more optimistic that we can get there. It's going to be a very arduous process given how crystallized the network is today. There are companies, though. There's a startup in Chicago, because we've looked into this, called Apostrophe. I'll give them a plug. That is doing exactly that. That says, look, forget about networks. We'll just pay the doctors cash. We'll pay them right away, and we'll pay them usual and customary. And it works, but when you get to complicated cases, it breaks down. Because now if you have a follow-up, and you got to refer, and you got to do more tests. So I think a lot more work does have to happen there. But again, I think I'm more optimistic that in the future, at least the network's role would be reduced, if not eliminated altogether.
So can I say one thing? I think the path to getting it reduced is actually to, and maybe it's inherent in what you said, but what we believe and what we see and have built a business to try to serve is that most people don't wake up thinking, I want to go to Sutter. I want to find a doctor. Most people wake up with a condition, a need. And what they're looking for is someone to help them remedy it, alleviate the pain, whatever. They're looking for, what are my options to do something about this? They're not automatically thinking, I want to see a doctor. But when you go to try to get help, so after they Google for a while and get really scared, then you go to, I won't say Sutter, you go to Stanford's website. And they don't give you options. They say schedule an appointment, right? And then come in and we'll fix everything for you. So
That's by design, by the way.
it's absolutely by design. So if we have more thought and more business models built around helping people understand their treatment options and the validity of those and how they might work for them based on how it works for others like them, if we start there instead of starting with doctors, hospitals, and drugs, I think we've got a shot to start to dismantle this construct of a captive network.
In my experience, that kind of trust is exactly what I deal with patients who don't trust institutions.
Yeah.
Don't also trust the treatment options. They want to find a human being who's going to be their treating clinician. That's the person they want to hear this information from. And right now, the insurance system seems to be set up to prevent people from connecting on their own or through referral with the clinician that's the best fit for them.
So I think coming back to like why insurance happened is to protect that same exact consumer. Because, and I'm an MD at practice, and I'll take the blame for it. And on behalf of all the physicians that didn't actually do good at the time when the cost kept rising, and they were billing folks, or the cash pricing was so varied and so different and didn't reflect their expertise. It did not reflect. And so people were going broke on that. And that's where the whole solution of insurance came about. If you go back, it's to protect the consumer, to develop a network that gives them some idea, hey, this doctor actually does better than the other doctor. Don't go there.
So we should probably wrap it up,
yeah.
because it's 8:35. But just as a closing statement for everybody, please try to make it sort of a soundbite statement. But how will consumers? So everyone can comment. But how will consumers perceive or view insurance companies 5 years from now?
It really can't get any worse, so hopefully they'll view it with sorry. Hopefully with more trust and with more ease.
Better, and I think more. I'll agree on the east side. I'm not there on the trust side.
Can you guys email us the results of the questionnaire?
Yes, we should be able to, yes.
Okay, but we're going to finish up.
Yes.
Go ahead, Steve.
Yeah, I don't think you'll think about insurance companies as insurance companies. I think you'll see the Kaiser-esque fully integrated models proliferate. There'll be slices. They'll be local. They'll be disease-specific. You'll have the diabetes insurance companies with providers that are embedded in the same way you're seeing these primary care businesses. I think you'll see it devolve.
Interesting.
Yeah.
I think it's going to be, again, very, very different. And we just believe that just digitization of everything is going to be a substantial change and change in the member experience to build the trust.
Crypto HSA?
Pardon me?
Your thoughts on a crypto HSA with a stable coin?
I hold out hope that at least some insurance companies will start to rebuild a little trust. We fundamentally believe it actually is starting with what people want us to do for them. So if you use the Christensen framework of jobs to be done, instead of over-serving them with things they don't want you to do, why don't you just do the things they want you to do well? And for us, that's focusing on, tell me clearly with yes or no answer, is something covered? Don't send me through a phone tree, give it to me on this. So tell me if something's covered. If you do that well, then maybe I'll ask you how much it'll cost me, not what it costs the company, but out of my hard-earned dollars. If you do those two things well, I might let you give me some information about what my options are and if the place I'm going to is safe. So we fundamentally believe the path to trust is actually to solve the things people want you doing for them now. We don't think that our job right now is to be the front door. I don't see that probably in 5 years. That's not a job you want your health insurance company to be. We're not trying to be that. We're trying to be clear on, here's your coverage, here's your price, here are some options, and here's the safety around those options.
Okay, with that, we're going to
So
have to
that-
wrap it up,
yes.
but we will have videos, we will have posts
survey results.
about the survey we took as well, and then obviously 2020, we will have 4 more of these intimate conversations, so please join us, go to vader.tv and